In this video, we'll be going over how to use the Heatmaps feature in Finviz to help find stocks that might be worth researching further and investing in, as well as identifying stocks that you may want to avoid. This is helpful for both beginner and experienced investors interested in individual stocks to get a quick visual overview of the market, as well as a screening tool for potential opportunities. By the end of this video, you'll be able to fully use these resources and incorporate them within your own stock research, or just use them to explore the market for fun. Before we jump in, if you're new here, my name's Michael, and take just a second to subscribe to gain access to more investment content like this in the future. So to begin, let's start off with an overview of the tools and the websites that we'll be using. The heat maps that we'll be using are from a website called Finviz, short for financial visualizations. And in my opinion, it has one of the best heat maps for visualizing the entire market at a glance. You can access the heat map by clicking on the heat map over here on the right, or by navigating on the ribbon and clicking on Maps. Once you do that, you'll be brought to a heat map here, which is a visual representation of the S&P 500, or the 500 largest stocks in the US by market capitalization. This is where we'll be spending most of this video exploring the features that you can use on this page to help get a quick visual overview of the market, as well as potentially identify any insights or opportunities with individual stocks. The heat map is organized both into broad sectors as well as subsectors, so you have the large technology sector here, financials, consumer goods, services, basic materials, healthcare, industrial goods, and utilities. Within each sector, there's also subsectors. So for instance, within technology, there's the application software subsector. So you can kind of see what companies are grouped in different subsectors. And this can help over time give you a better sense of all the individual stock investment opportunities and businesses there are out there, and where each of them fit in relation to the general market. The size of each stock box is correlated to the market capitalization of the stock, which is why the largest boxes are Apple, Amazon, Google, Facebook, and Microsoft. So when you just open the heat map for the first time, what you'll be looking at is actually the one-day performance. So this will be the percentage price change in the stock compared to the close on the previous day. This is helpful if you wanted to just get a quick sense of where the market is today. Not that this necessarily has much relevance to long-term investors, but it is still interesting to see. What I'd argue is probably of more relevance is some of the other views we can take a look at through this heat map by clicking on the drop-down menu here. For instance, instead of looking at just the one-day price performance, we can also look at the one-week price performance, which covers the price change of the stock over the last 5 trading days. Again, this is still relatively short-term, but you can lengthen this period over which it maps out the stock price change all the way up to 1 year. And we'll get there in a bit, but first I want to start out with the 3 months performance. So this looks at the stock price change over a 3-month period, not including dividends, but this is long enough of a time frame that it includes the most recent company's earnings and can work as a starting point as a general market overview as well as exploratory research. So you've got the 3-month performance heat map up now. How would you exactly go about looking into this? Well, first question I would ask is, are there any stocks that have seen significant price declines? If so, why did that occur? And is there potential for an investor overreaction in the short term to create a long-term investment opportunity? These price declines are shown in red, and an example, we'll take a look at Starbucks, which over the last 3 months, at least at the time of this video, is down roughly 14%. So looking at the stock price chart, we can indeed see that the price fell during those last 3 months, but if you take a slightly more longer term view, it's still up significantly since the beginning of the year. Now keep in mind that the price alone doesn't tell you much about the stock, or at least what it's worth, and you'll need to compare the stock price to the fundamentals to get a sense if the stock is trading at a fair valuation or if it's potentially over or undervalued. Well, this is certainly not the most rigorous fundamental research. For the context of this video, and just to get a quick overview of fundamentals, we'll be using the website called Macro Trends to quickly look up some of the fundamental metrics for each of these companies in the video. So for Starbucks, we can take a look at the price to earnings ratio, the ratio of the stock price to the company's earnings, with a high PE ratio being a stock that's relatively more expensive compared to earnings, and a low PE ratio being a stock that's cheap relative to earnings. So from the Macro Trends website, we can see 3 things. The first is the stock price. The second is the trailing 12-month earnings, or net earnings per share. And the bottom piece is the price to earnings ratio, which is just the ratio of the above stock price over the earnings per share. So right now, Macro Trends has the PE ratio of Starbucks at 36. If we go back to Finviz though, they have the price to earnings ratio at 28. And part of the reason you might see differences in these metrics on some websites compared to others is that each website might use a different set of earnings data. When companies produce earnings, sometimes they make things called adjustments and report both adjusted earnings per share as well as unadjusted earnings per share. So depending on which numbers the website pulls, they may produce slightly different results. So that's really on us to sort of figure out and determine what are the appropriate values to use. In the case here for this analysis, I'm not worried too much about what the exact absolute value is here, but I'm more worried about where Starbucks stands now, at least relative to its historical valuation in the past. So from this, we can see that the price to earnings ratio of Starbucks now is the highest it's actually been in over 10 years. Starbucks was arguably undervalued in the middle of 2018 when it had one of its lowest price to earnings ratios in history. But since then, it's gone from undervalued to looks like what is a fair valuation to now, with the highest price to earnings ratio in 10 years, likely an overvalued scenario. Within macro trends and using the top ribbons, we can explore a few other fundamental metrics to maybe get a better sense of the picture for these stocks. In this case, we're now looking at revenue or total sales, and the top graph representing the trailing 12 months revenue or the last full year of revenue. The second graph being the quarterly revenue that is produced each quarter, and the bottom chart being the year-over-year revenue growth rate. So one thing to note in Starbucks history is that the growth rates were highest earlier pre-recession. Once the recession hit, growth turned negative, but then has been relatively steady since then. However, it's interesting to note that through much of 2011 to 2015, growth was in the double-digit percentages. However, from 2016 onward, revenue growth for Starbucks has been below 10% on average. So that raises the question, if revenue growth is slowing, but the stock is the most expensive it's been in 10 years, at least according to the price-earnings ratio, why is this happening? Well, if we take a look at the shares outstanding for Starbucks, we can get a little more insight into the situation. What we can see is that since the end of 2018, Starbucks has been very aggressively repurchasing its shares, which have significantly reduced its share count. Through stock buybacks, they can actually increase earnings per share by reducing the amount of outstanding shares that the total company earnings are split between. However, when we look at Starbucks' long-term debt, we can see that those buybacks were funded through an increase in debt issuance. So you're trading off a lower share count and better earnings per share with more debt and a slightly weaker balance sheet. This makes sense if they are repurchasing shares in mid-2018 when the shares were cheap, but I don't think it makes much sense anymore. Given that the stock was trading at the highest valuation in over 10 years back in August of 2019, I think this price decline is more than justified. So that should give you an example of the kind of quick analysis you can do when screening for potential stock opportunities and doing a little initial research. We can actually take another look at a services stock, in this case in the specialty retailer subsector, with the company Ulta Beauty. Now the stock of Ulta Beauty crashed on their earnings report when they reported slower expected growth in their makeup and facial cosmetics segment. However, big 20% plus drops in stock prices are actually quite interesting because sometimes this can be an overreaction to sudden, apparently bad news that can scare many short-term investors, but potentially create long-term investment opportunities. To understand this again, we can do a bit of initial research. Taking a look at Ulta's revenue over the last 12 years, this is a stock that's done very well to compound its growth over the years. From 2010 to 2017, revenue growth was very consistent, averaging about 20% or more per year. However, beginning in 2018 and most recently in 2019, that revenue growth has slowed significantly, now down to about 12% year over year. This is close to the revenue growth rates we saw during the recession, where Ulta was a much smaller and faster growing company at the time, but it was much harsher economic conditions. To get a sense of the valuation, we can take a look at the price to earnings ratio over that period in time. And right now, Ulta is trading at the lowest price to earnings ratio since the Great Recession. Now, had you bought Ulta at a price to earnings ratio of 20, roughly what it is about now, back in 2009, you'd have returned well over 25 times your initial investment. Put that another way, a $10,000 investment 10 years ago would now be worth $250,000. Now, given that Ulta is a much more mature company now, I don't think expecting that level of growth from this price to earnings ratio now is really a reasonable expectation. However, if you're under the impression that this is a more temporary slowdown in growth, then at least compared to historical averages, this might look like a compelling investment opportunity. This is where it can get a little bit tricky because a price to earnings ratio of 20 isn't necessarily cheap, especially if the company growth slows even further. However, if Ulta is able to get back to those higher growth rates, or even just maintain the growth rates that they have now, investors should still be able to benefit from the growing earnings per share over time, as well as the price to earnings multiple to expand or grow back to a higher level, which would in turn increase the stock price. Looking at the longer term price chart for Ulta, you can see that Ulta has had some of these significant declines in the past, but over time the business performance has just continued to grow, and eventually the stock market realizes that, and the price then appreciates to match the growing business performance. So altas is definitely an interesting opportunity that I'm looking at. For me, I don't think it's quite at the level where I'd initiate a position just yet, but I'm fully aware that, I could potentially miss out on the opportunity there. But that's just my personal style of investing, trying to have a little bit more margin of safety to limit the downside. But I would not be surprised at all to see the stock trading above 300 or up 25% by sometime next year. So I'll be continuing to keep my eye on this, but this is, in my view, a perfect example of the kind of opportunities that you might be able to find by just doing a quick screen on Finviz using their heat maps. And you can apply this screening to really any time range. I think the 3-month, 6-month, and 1 year work the best, just since those actually have at least 1 quarter of recent earnings data, but you can pick and choose what you like best. For the 6-month performance, one that sticks out is Netflix. This is a stock I've talked about a bit on the channel before, and I've argued is overvalued. Primary reason just being a fundamental argument. This is the revenue growth for Netflix, and they've had very significant revenue growth per share. But if you look at the bottom graph, which is the price to sales ratio, while they have had this strong growth, the valuation, or price per sale or price per revenue, that the company is trading at, that's gradually increased over time as well. So this leaves potential more downside in the future if that price to share ratio were to fall, even if revenue and revenue growth remain the same. But long term, what investors really care about are profits, not necessarily revenue. And Netflix has always traded expensive relative to earnings. Even given the significant growth in reported earnings per share, the company's still trading at roughly 80 to 90 times earnings, which is many times greater than the market average. To put the price to earnings ratio in another perspective, for every $90 you have invested in Netflix stock, you're only getting about $1 of reported earnings. If you bought a company with a price to earnings ratio of, let's say, 20, you're getting 4.5 times more earnings per every dollar invested. And the strongest argument I have for Netflix being overvalued is not the earnings, but it's really the cash flow that Netflix generates, or in this case, burns every quarter. The thing about earnings is there's more flexibility for management adjustments to report positive earnings per share each quarter, but cash flow is really just the raw transactions the company makes, and that's not something that can be easily adjusted. From this, we can see that Netflix is not only burning cash, but they're doing so at an increasing rate. Over time, this is going to catch up to the company, and the main way that they've been financing this is just through increasing more and more long-term debt. Long-term, this isn't really sustainable, so if Netflix sees a slowdown in growth, investors have reason to be concerned. So in my view, this price decline is perfectly justified, and I would even say that Netflix is still very expensive at $300 per share. So going back to the heat map, in addition to just looking at the price performance over a certain period in time, you can also look at fundamental metrics like price to earnings or forward price to earnings ratios to get a quick glance of where valuations stand in the market and which stocks or sectors in the market are relatively expensive and which ones are relatively cheap. Looking at price to earnings, a price to earnings ratio of roughly 15, or about an equivalent 7% earnings yield, is roughly middle of the road. So anything above 15 will be shaded red, and anything below 15 will be shaded green. One thing I would note is take price to earnings ratios with a grain of salt here, because sometimes companies will make one-time adjustments. For example, writing down an asset that they paid too much for in the past, or potentially recognizing a one-time tax benefit. These things can skew the earnings data from the last 12 months, so sometimes you might prefer to use the forward price to earnings ratio to get a smoother, more standardized view of what future earnings are expected to be relative to the price of each company. So one thing we can get from this by looking at the forward price to earnings ratio is to see visually some sectors and stocks that are trading more cheaply and others that are more expensive. For instance, banks and insurance companies are trading at relatively low price to earnings ratios, but it's important to keep in mind a couple factors. One, for instance, for banks and other financial companies, interest rates are relatively low in this environment, so expected earnings from interest income will likely be lower in the future as well. Additionally, many companies in the financial sector don't usually trade at relatively high price to earnings ratios to begin with, so seeing price to earnings ratios in the low to mid-teens shouldn't come as too much of a surprise. Other stocks trading at low price to earnings ratios include many of the major airliners, drug distributors, Kroger, a grocery store that I actually own in my portfolio, drug manufacturers, biotechnology, and healthcare plans. Healthcare plans is an example of what I thought was an opportunity, maybe a little less so now given the recent price run-up, but an area in the market that I still think has potential for long-term market-beating returns. Cigna, a health insurance company, is one company whose stock had been buying throughout this year. which I believed was undervalued because despite still having strong rates of growth, it was trading at a price to earnings ratio that was not only a discount to the market, but a discount to Cigna's historical average price to earnings ratio. So that's just another example of how you can use the heat map in combination with a fundamental metric like price to earnings ratio or forward price to earnings ratio to help identify potential opportunities. I will say that price to earnings ratio isn't everything though, and you should keep in mind economic cycles when thinking about some certain stocks. For instance, if you take a look at the major auto manufacturers, General Motors and Ford Motor Company, they're trading at very low price to earnings ratios of 6 and 7 respectively. That, without any other information, seems like a good deal. However, you have to keep in mind that both Ford and GM are in very cyclical industries. The market pricing these stocks at a low price to earnings ratio means that on average, investors aren't expecting to see significant earnings growth from either of these companies and are likely pricing in a potential decline in earnings. This is something that could easily happen during a recession or even a minor economic slowdown. So do note that a low price to earnings ratio doesn't necessarily mean it's cheap, especially if the stock and company is in a very cyclical industry. This kind of analysis can be helpful for finding stocks that might be interesting to invest in, but it can also be used in the opposite way to find stocks that you might want to actually avoid. And honestly, this can be just as helpful in helping improve your long-term investment returns because Warren Buffett's first 2 rules about investing are to never lose money. If you can avoid the stocks that are likely to present rates of return for your portfolio that are below the market average or even worse, that could possibly incur you a loss of principal, then effectively you've narrowed down your investment opportunities to only the ones where the risk reward is in your favor. An example of a sector I believe is actually overvalued at this point in time is the personal products subsector of consumer goods. For instance, Procter & Gamble and Colgate-Palmolive are trading at roughly a 23 and 22 price to earnings ratio. This is a fairly high price to earnings ratio for personal products companies that aren't really experiencing much growth. Now, this isn't exactly an apples to apples comparison, but for instance, if you take a look at Google, who's trading at a forward price to earnings ratio of 24, just a little bit higher than that of Procter & Gamble, Google is seeing revenue growth in the low 20% or high teens, while Procter & Gamble will likely see revenue growth in the mid single digits. So if I were to look just between Google and Procter & Gamble, I would say, relatively speaking, Procter & Gamble is much more expensive than it should be, at least relative to a fast grower like Google. So personally, I would not own any of these stocks in my portfolio as I believe they are overvalued. So that's just another way you can use these heat maps also as a relative comparison when those comparisons make sense. Now, in addition to the price to earnings ratio and forward PE, there's also some other fundamental metrics like price to earnings growth ratio, price to sales ratio, and price to book ratio. But I don't really like using these 3 too much because there's not as much apples to apples comparison, and it's a bit harder to compare against different industries, which generally have different subsets of ratios or ratio ranges that you'd expect. You can use them, but I don't really use them that much. One thing that might interest some investors, especially investors who are more income focused or potentially dividend growth investors, is the dividend yield and the projection on the heat map. So with this, you can get a quick sense of companies who are paying dividends, companies who are not paying dividends, which are in black, as well as companies who have a relatively high dividend yield. One thing I note with this is that if you're investing for income, especially if you're looking at companies with relatively higher dividend yields, make sure to take a look at the balance sheet of these companies and make sure that dividend is sustainable, because if not, you may be experiencing a cut to that dividend in the future. And dividend cuts do sometimes happen even in the S&P 500. We saw that with General Electric. We also saw that with Kraft Heinz. Both companies were paying a dividend that was not sustainable given their earnings and cash flow and current health of the balance sheet. Again, it's something to keep in mind because dividend payments are not guaranteed in any way, and they can be cut or eliminated at any time. One of the final maps that you can look at, which I don't really think is a whole lot use on its own, but it is at least interesting in my view, is the float short. So this effectively tells you out of all the shares that are floating out on the open market that are available for the public to buy, what percentage of those shares are held short, or are people betting against the price of the stock or expecting the stock price to fall. Oftentimes, highly shorted stocks are in industries that are likely seeing a secular decline or have other negative forces acting upon it, at least in the short term. For instance, it probably doesn't come as too much of a surprise that many of the apparel retailers, as well as some of the department stores, are some of the most heavily shorted stocks in the S&P 500. This is at least one metric of market pessimism, and if market pessimism gets too high, it could cause these stocks to become undervalued, as well as set up for what's called a short squeeze, when eventually the market realizes that the stocks have been too heavily beaten down, and short sellers rush to the market to buy back their shares before prices rise any further. Again, I wouldn't base any investment thesis on short float alone, but I think it's interesting to get at least a perspective of market sentiment for some individual stocks and sectors. One thing I should also note is that while we've just been looking at the S&P 500 for today, you can also look at this for other international stocks as well as sort of the full map of both international stocks in the S&P 500, and stocks that are in the US but not listed on the S&P 500. Generally for me, when I'm using these maps, I look mostly at the S&P 500, mainly because on average these are generally more mature companies, and I know that financial reporting is regulated and standardized for a more apples to apples comparison across stocks and industries. But you're very much welcome to check out and explore the world and full heat maps as well. I hope you found that useful. Stock screening and research can take a fair amount of time, so I'm always appreciative of efficient ways to aid in that process. In my view, Finviz's heat maps are a great tool for both beginner and even experienced investors to get a quick overview of the market and maybe identify any potential investment opportunities or stocks to avoid. If you like this video, please give it a thumbs up. It's the best way for me to know which videos you enjoy the most and which I should make more of in the future. If you have any comments or questions about anything covered in this video or things that you'd like discussed in a future video, let me know in the comments below and I'll try my best to get back to you. Until next time, thank you so much for watching. My name's Michael and I will see you in the next video.